Hey option traders, for today's trade we are looking at an option play in software stock Adobe. So taking a look here on MarketSmith, the stock has had a big crash last week, falling close to 17% in one day following news of their acquisition of Figma for $20 billion. This occurred just a few days after the company found resistance at its 50-day moving average. An RS rating here of 12 shows that the stock has been a massive underperformer in recent months. Also, an IBD group ranking of 195 out of 197 shows that this group is certainly not a leader at this time. Also, decelerating EPS and sales growth in the most recent quarters is another trend that shows underlying weakness in this stock. One bright spot for the company is that earnings are estimated to pick up again in 2023, where Adobe is expected to show EPS growth of 16% on a year-over-year basis. With the stock below key levels of support, you could consider putting on an option strategy in Adobe known as a diagonal put spread. So a diagonal put spread is constructed using put options, as the name suggests. It is used when investors expect the underlying stock price to fall. So remember, with options, there are two types of options. There are calls and then there are puts. With both calls and puts, you can either be a buyer or a seller, just like with any stock. You can either buy it long or sell it short. A bearish diagonal put spread is constructed by buying a put and selling a put simultaneously. This spread is a debit spread, which means that you'll pay a premium upfront for initiating the trade. It also means that the option you bought is more expensive than the option that you sold. Together, these two options create a spread. The difference in strike prices creates a specified range. The investor can expect a profit or a loss based on where the stock trades within that range. Another important aspect of this spread is that both puts are on the same stock, but they have different expiration dates. This is also referred to as a time spread. So let's use an example. Say I have a bearish assumption on XYZ stock and implied volatility is low. This could be a good time to put on a bearish diagonal put spread. So say the stock is trading at around $100 a share. To set up this diagonal, I'm going to look at buying a put with a 110 strike and selling a put with a 90 strike. The higher strike 110 put is considered in the money because if I owned that put, it would allow me to sell the stock instantly at a higher price than it trades at currently. This instant profit potential means that the put is in the money. The lower strike 90 put is out of the money, given that the option has no profit embedded in it at the time of initiating the trade. Now, both of these put options not only have two different strike prices, but they also have two different expiration dates as well. The higher strike 110 put that I'm going to buy should have an expiration that's further out in time. The lower strike 90 put should have an expiration that is nearer in time. Investors can estimate the profit potential of this trade by taking the width of the strikes, which in this case is $20, and subtracting the net debit paid. So let's say I purchased the 110 strike put, which expires in November for $15, and sold the 90 put, which expires in August for $5. That nets a debit of $10, which is my total cost for the trade. The $20 spread minus the $10 net cost shows a profit potential of roughly $10 per share per contract in this trade. So now that you have a better understanding of the mechanics of this trade, let's take a look at my trading platform and set up a real life example. So to set up this trade, first make sure you're in ADBE, ticker symbol for Adobe. And if you are on Thinkorswim, you can select diagonal as your spread type here in this box, which will make it a little easier to set up the trade. Now, you're going to want to make sure at least one of your expiration dates in the expiration date drop down here that you choose. Just make sure one of them is October 21st, 2022, and then you can adjust this other date here down below. So we'll go to the strike prices here, look on this side of the screen for put prices. I have selected here the 260, 250, and we're going to adjust the 250 down below. And here I have the trade set up and ready to go. you want to make sure you are buying one 245 put that expires November 18th, and you want to make sure you're selling one 260 put that expires October 21st. For this trade in Adobe, we are looking at selling an October 21st put with a strike price of 260 and buying a November 18th put with a strike price of 245 to create the spread. This option spread will cost roughly $10 in premium, and that's the most the trade could lose on the upside. The strategy earns the most profit if Adobe closes right at 260 on October 21st, where the profits are estimated to be around $550 per contract. But the trade has a nice profit zone between 250 and 303. Aiming for a return of around 10 to 15% makes sense for this trade, and I would consider using a similar stop loss percentage as well. The worst case scenario is a sharp drop in Adobe early on in the trade. For this reason, if the stock drops below 260 in the next few days, consider closing the trade early to minimize losses. As always, remember that if you are new to options, make sure you practice in a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. So be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.